Welcome to the DIY Wealth Canada podcast, a show by independent investors for independent investors. Join hosts Bob and Nelson as they discuss investing, personal finance, and much more, all from a fiercely self-reliant Canadian perspective. As a reminder, nothing you're about to hear is investment advice. Thanks for listening and enjoy the show.
Hey everybody, welcome back to the DIY Wealth Canada podcast. I'm Bob here. Alongside with me is Nelson, my co-host. We got an exciting episode for you today. We're going to talk about home country bias and why it may or may not be a good idea to have home bias. Yeah, Nelson, you want to give the listeners what it means by home country bias?
Sure. So what happens with a lot of Canadian investors, and this is a especially Canadian problem for reasons I'll talk about in a minute here, is the Canadian investors tend to have a lot of their portfolios invested in Canadian companies for various reasons. And in doing so, they ignore a big chunk of the world's stock markets. In fact, they ignore the vast portfolio of the world's stock markets. If you take a look at each country's weighting by market cap in terms of the total world stock market, what we find is that Canada has about 3% of the world's weighting. We have a very small economy compared to the neighbor right next to us, of course, the United States, but also compared to even countries like China and even Brazil and these kind of emerging market economies. So Canada is a very small part of the world's economy, yet a large percentage of a lot of investors' assets. And the problem with that, of course, is very simple, is that the Canadian economy has certain unique challenges. It might underperform compared to other countries like, say, the United States, which is what's happened lately. And in keeping your money in Canada, not only are you taking the concentration risk of just investing in Canadian companies, but you are missing out on potentially the rest of the world's economy, which could perform much, much better than Canada because they don't have the issues that our local economy has. So that's essentially it in a nutshell that we're going to talk about today.
Yeah, and the one thing to keep in mind is if you look at the Canadian economy or if you look at the TSX, if you look at from a sector point of view, a lot of Canadian companies are either in the financial sector or the energy sector. So by investing in primarily Canadian market, you're exposing yourself in these two segments, right? So if you look at the TX, there's not that many, call it consumer staples or consumer discretionary companies, not as many compared to the US. And technology, for one, there are way more big names in the US compared to Canada. So that's something that you need to consider. Yeah, and I know personally, we hold quite a bit of Canadian equities in comparison to like the makeup of the Canadian global stock market capitalization, right? Like as Nelson mentioned, Canada makes about 3% global stock market capitalization. So when you're owning, 50, 60, 70, 80% of your equity portfolio in Canadian stocks or ETFs, you're not really exposing yourself to the greater global economics. So you're tying yourself to the Canadian stock market return and maybe in some way hamper your return, right? So that's something to consider.
Yeah, for sure. And you really nailed it in terms of the sectors, because you look at Canada, we have this massive financial weighting. Our big banks are huge in comparison to other markets and their big banks. Banking is a big business, but ultimately Canada's banks are really big businesses in terms of their impact and their weighting on the stock market. And two is that these companies will weigh so much on the Canadian stock market, these 6 large banks, that I think combined make up something like 30% of the TSX. I might be wrong there, like whatever the percentage is, it doesn't really matter. The point is that you look at these large financial companies and they really matter. And what happens in that situation is that you think you're making a bet on the Canadian economy, but actually you're making a bet on the Canadian banks and then Canadian life insurance companies, and then you're making a kind of a smaller bet on the Canadian economy. Now, saying that, we look at the United States, and the S&P 500 has increasingly also become a bet on one sector, and that sector is technology. So what it comes down to is that when you concentrate on one thing or on one country, and you do so without the thought process of realizing what's under the hood of that investment. If you're just buying the TSX composite, you're just buying the S&P 500, keep in mind that you're essentially making a concentrated bet on one sector, and that could turn out poorly, whether that's a Canadian home country bias or a US home country bias, or Australia, which is their market is dominated by mining companies. They also have very large, their banks are a little bit like our banks, where they're very large kind of institutions in terms of the size of their market. So the point is that this bias that exists in Canada, it also exists in other countries as well. And it's just something to keep an eye on. Yeah. And just make sure that you know what you're getting into.
Yeah, so let's talk a little bit about why investors exhibit home country bias. So that it happens with every country, right? Like if you're in the US, you have a tendency to invest more in the US companies. If you're in Canada, you invest more in Canadian companies. If you're in China, you invest more in the Chinese companies, and vice versa. Right? I think the number one reason for this investor home country bias is the familiarity and comfort. Right, when you're living in Canada, you understand and you see how these companies perform, how you see them in your day-to-day life. So like you understand the Canadian banks, the pipelines, grocers far better than say like a German manufacturer or a Japanese manufacturer or company, right? So because you're using them during your day-to-day life, you have more comfort and you think you know them better, therefore makes you want to invest in these companies rather than some companies that you don't know as well. Any other reasons one might prefer investing in home country companies versus foreign companies, Nelson?
I'll get into the second reason in a minute here, but I want to further your story there about the familiarity and everything, because that we talked a few episodes ago about hedging your consumption and buying shares of companies that you are forced to consume their products, whether it's your cell phone, your utility provider, whatever, and how that can be a source of good returns. So there's positives to it, but at the same time, Bob, you're right, where it's like we are familiar with these companies and we are perhaps a little bit overconfident when it comes to familiarity. I remember once I was in an investor kind of group on Twitter, and somebody pitched a Korean company that made tape measures. And I remember it was incredibly cheap, and it was like the value investor in me was all excited about it. And then I realized that I didn't know anything about the Korean hardware market. I could tell that these tape measures existed in Canada and that, they had space at Home Depot, but I didn't know anything about the Korean market. So I couldn't invest in that just based on that. It's like I just couldn't get comfortable with the situation. And so that's a reason why I would not, put money to work in like a Japanese company or a European company, even though I am maybe more comfortable with that now as I've traveled and I've kind of, gone over to Europe, and I can see that, like Carrefour is a very big deal in France and so on. But anyway, so number two reason why Canadians especially will concentrate in Canada is on the dividend side, is the dividend tax credit. And of course, without getting into too much detail, maybe we should do it for a subsequent episode. But if you only have dividend income, then you can make something like $70,000 a year, depending on the province. All their tax rates are slightly different, but you can make up to $70,000 a year tax-free. And so if you're retired and then you add, say, CPP and OAS on top of that, what you'll have is a income approaching six figures, but the tax rates are very, very low. So there's definitely an advantage in doing that. But unfortunately, there's a big disadvantage to that too, is that not only have you concentrated into Canada, but you've concentrated into just a small part of the Canadian market, which is Canadian stocks that pay relatively generous dividends. And in markets where that strategy doesn't really work out, like 2023, it wasn't that long ago, the strategy performs quite poorly while the rest of the market might be doing better, that employs a different strategy or invests in different sectors.
Yeah, for sure. And then two other reasons I could think of. One would be having to exchange currency. If you buy Canadian companies, you just buy in Canadian dollars, whereas if you want to buy US companies, you most likely have to trade in the US stock market. I mean, you have to convert Canadian dollars to US dollars, and the exchange rate plays a huge role in terms of your return. So that kind of complicates things when you want to start investing in the US market. And then the other thing maybe is not too big of a deal if you're investing in Canadian and US companies, because we both countries use the same language. But imagine you want to invest in a Chinese company or Japanese company or German company where their investors' relation and any documentation that you find on their website are in their language. So it makes it harder to understand what the company is reporting. And also you're not as familiar with any regulatory environment or the local requirements. So it becomes harder to really understand what these companies do and the little nuance that you need to be careful as an investor. So those are two other reasons I could think of why you might prefer invest in Canada over other countries. And as a result, you exhibit the home country bias.
Yeah, too, in furthering that point you're making about other markets, is not only do you have to deal with other languages and other regulatory environments, is that you have to deal with political risk. And you look at countries in, say Latin America, in Southeast Asia, that perhaps aren't as stable politically. You have to worry about the companies that you're investing in having to play nice with the government. And we remember a few years ago when Russia first invaded Ukraine, there were companies that lost a big chunk of their market cap because they had assets in Russia that were essentially stranded because nobody would do business with Russia anymore. So they were just forced to essentially sell whatever product it was to Russians, and that was it. And that was a big issue for a lot of these companies. Venezuela, that happened. I have shares in a company called Coca-Cola FEMSA, which is Latin America's largest Coca-Cola distributor. And Coca-Cola FEMSA had assets in Venezuela up until 2017, I believe, and then they were just gone. The new government came in and decided that it owned these Coca-Cola assets, and they were just, there's no more Coca-Cola in the company or in the country, or if there is, it's illegal. I don't know exactly what's going on in Venezuela, but the point is that you have to worry about those things as well when you venture outside of Canada. And some people might not want to do that, or they might just decide to throw up their hands and take the easy way out and just buy a ex-Canada ETF and just get all of that exposure in one shot. Bob, what do you think of that strategy?
Yeah, so that's interesting. I wanted to get into that just about now, but one stock that got hit by the Russian-Ukrainian war was Magna International, because they have a lot of assets in Russia. So yeah, there's definitely geopolitical things you have to consider. Yeah, like Nelson, you talked about the ex-Canada ETFs, and that's why I want to pivot a little bit, talking about even we just talked about home country bias. Now, really, I want to dive into a little bit deeper on how can we avoid this bias and why investing in Canadian companies may not necessarily mean that you're 100% concentrated in Canada. So talking about the ex-Canada ETFs, I think those ETFs are great ways to increase your diversification geographically. We own the XAW, so that's the iShares ex-Canada International ETF. So it invests in everything else but Canada, right? So if you look at the composition of XAW, I think around 60% of the fund is tied to the US market and then other countries. Vanguard also has similar ETF, I think it's called VXC, and other fund companies do have those ETFs as well, ex-Canada ETF. So I think owning an ex-Canada ETF is a great way to increase your diversification. And that was the main reason for us to get into XAW, just to increase our exposure outside of Canada, right? So most of our dividend portfolio is made up of Canadian companies. We do own some US companies, but obviously we don't own any European companies or Asian companies. And quite frankly, it's very, very hard to invest in these non-North American companies. So one way to do that is through these ex-Canada ETFs. So that's one way to increase your diversification outside of Canada. And I would definitely recommend everybody to look into that in terms of increasing your exposure outside of Canada. You definitely don't want to be tied to the performance of the TSX.
And the beauty of those types of ETFs too, as well, if you get those ones that, they have specialty ETFs that allow you to invest in, Mexico directly or Brazil directly or whichever country you want directly. And that can be a way to also get that exposure. But at that point, you're making a specific bet on a country again, and you might like that country for whatever reason, but at the end of the day, that's a specific bet on a specific country, and there's some risk there. But in terms of the more broad market diversified ones where you get a little bit of every country with a lot of US exposure, the fees on those are very, very low. Bob, I don't know what exactly the fee on that ETF would be, but I would guess it would be somewhere in the 10 to 20 basis points every year, just very, very cheap.
Yeah, for sure. I'm just looking it up right now. I think if I recall correctly, like 0.25%, something like that, or less. Actually, 0.22%, the management fee for XAW. The VXX used to have a little bit higher MER compared to XAW, and that was one of the reasons why we switched over from VXX to XAW. But now I think both XAW and VXC are more or less the same in terms of management fee. And quite frankly, these ETFs, they're always changing the way they structure, so these fees tend to go lower rather than going higher. So that's a win for investors like you and me.
Yeah. Do you worry about the large US exposure in those ETFs where it's like you're trying to get away from the one country concentration, and all you've done is just sort of switch that one country concentration to another country? How do you feel about, I think you said it's like a 50 or 60% US exposure. How do you feel about that? And is that maybe one of the reasons why you would keep that as a smaller part of your portfolio rather than, say, putting all of your money in that?
Yeah, that's definitely something you need to consider. But if you look at, and this is definitely a thing for the Canadian companies as well, and that's why I think home country bias is less and less important in today's environment, is that many of these companies that you would invest in are multinational companies, right? So if you look at the S&P 500, NVIDIA, Apple, Microsoft, they don't just make money from the US, they make money internationally, right? Apple sells their iPhone, their Mac to everybody on the globe, right? Coca-Cola, they sell Coke to, you can find Coke everywhere. McDonald's, you can find McDonald's stores everywhere, right? So they're not just making money from the US, they're exposed internationally. And even if you look at Canadian companies like the Canadian banks, right, like Royal Bank, TD, they don't just make their profits from Canadians, right? TD has a really large exposure in the US, Royal Bank as well. I think Royal Bank has exposure in Europe, right? Bank of Nova Scotia has been trying to expand in their Latin America exposure. Now that hasn't really paid out as much. But you look at even insurance companies like Manulife, they have big exposure in Asia Pacific, and they just invested a large amount of money in a joint venture in India, trying to expand into that market. So even though you may own a quote unquote Canadian company or US company, you're not really tied specifically to that country anymore, because these companies are multinational operation, right? So it's more and more becoming a global environment where just because you own 50% of your portfolio with Canadian company doesn't mean you owe that 50% is tied to Canada, right? It could be a lot less. So that's where I think the home country bias is something to consider for sure, but it's playing less and less of a role, in my opinion.
I think too, when you look at the composition of the stock market versus say 30, 50, 100 years ago, back then you had a lot of old school businesses. Now you have these kind of capital light technology companies, even the non-technology companies, Canadian banks, Canadian life insurance companies. Yes, these are not technology companies, but they are nimble. They have the ability to move capital around the world fairly easily, and they can sort of move money into areas where they find more attractive growth prospects. You talked about the Manulife and their expansion in Asia. Sun Life, it's the same thing. Great West Life, you've got some expansion into Europe, and then kind of in the US, they're expanding it, retirement providing. So like you put your 401k in, and Great West Life manages it, empowers their US brand. So the point is that you have all of these Canadian companies that can move their money around fairly easily, and that the world is a lot different than what it used to be in terms of it's much more acceptable now to move your money around fairly easily. In the history of Loblaws and the Weston family, and I've read a book on this, and it's a really fascinating book. One of the things is that in the kind of 1920s and 1930s is that Weston expanded into Great Britain and Ireland, and then sort of created this business over there. And back then, that was almost unheard of. And then the Canadian banks kind of did the same thing as they moved across Canada, was that they had these businesses that could travel long distances. And that was a very big deal at the time. That was a challenge for these guys. And now it's not a challenge. So the point is that you have all of these companies that trade in Canada that are on the TSX, that are Canadian companies. And then when you look underneath the hood, you have a lot of US exposure, European exposure, Asian exposure that just really takes away that home country bias risk. You still have some there because at the end of the day, these are Canadian companies with Canadian exposure, but it's far less than what you would think. And that protects investors if Canada performs poorly.
Yeah, for sure. So that's one thing to consider when you talk about home country bias. Now, we mentioned about exchange rate, and yeah, let's talk about exchange rate, right? So I mentioned earlier that converting Canadian dollar to US dollar, it's painful because if you're just converting using your online broker, typically these brokers charge anywhere from 2 to 2.5% to convert the currency for you. So not only you need to be careful with the exchange rate because the exchange rate varies day to day. You also get hit on top of that 2 to 2.5%, right? So a lot of Canadians, what happens, they use this thing called Nuremberg Gambit to avoid that 2 to 2.5% in charge that your brokerage would charge when you convert between Canadian dollar to the US dollars and vice versa, right? So Norbert's Gambit, essentially you're buying an ETF in the Canadian dollar, and then you're journaling to the ETF to the US equivalent that trades in US dollars. And once the journaling finishes, you would then sell and get US dollars back. Now, obviously, you need to do this when there's something that's listed both on the Canadian side and the US side, or an ETF that has the US and Canadian equivalent. So that's one way to save some money when you try to convert Canadian to US dollars or vice versa.
Yeah, I love Norbert's Gambit just because I think it's like, you know how you're kind of sticking it to the man sometimes when it's like in Monopoly, bank gives you $200 because the bank screwed up. I love that feeling of sticking it to the man with Norbert's Gambit. It's like you've outsmarted the brokerage or whatever. But at the end of the day, there are some disadvantages to Norbert's Gambit that I feel like I should bring up. One is that if you're still paying for trades, you have to pay for the sell and the buy. So you have two transactions that you have to pay for. And there are a lot of brokerages that don't charge anything for trades, but a lot of them still do. So you have to factor that in, first of all. Second of all is that you have to do the work of journaling. Bobby talked about where you buy it in Canada, and then you have to tell your broker that you want to convert the shares from Canadian dollar shares to US dollar shares, and then you have to sell. Well, that takes a little bit of work. And some brokers will actually make you call in and talk to them and say, hey, I'd like to journal these things over because I'm doing Norbert's Gambit. And they'll do it. But the point is that it takes some time and it takes some energy, and that might annoy some people in doing that. I know I personally don't like to phone in and talk to a company unless I absolutely have to. The good news is that most companies most brokerages that offer Norbert's Gambit will let you do the journaling process online. You just have to go and find it and do it. But again, that takes time and you have to know what to do. So that's a downfall as well. And finally, in the couple days that it takes to make the conversion, is that sometimes the currency will move against you. Sometimes it will move in your favor, so you'll make a little bit of money doing it. But the point is that you do create this risk of the currency moving not in your favor while you're waiting the day or 2 days that it takes to make this thing happen. So at the end of the day, it's cool. I like it, but there are potential disadvantages in there. And luckily there are brokerages. International Brokers is Interactive Brokers, not International Brokers. That doesn't exist. Interactive Brokers lets you convert currencies for a very small fee. And if you're a generation client at Wealthsimple, you can also convert currencies for a very small fee. So at that point, maybe that's the way to go rather than doing Norbert's Gambit. But at the same time, Wealthsimple does plan to offer Norbert's Gambit there. So yeah, anything else on Norbert's Gambit? It's hard to say. Am I?
Yeah, for sure. Anyway. I think one thing you touch point on is the time it takes to journal, right? So typically, I think it's the easiest way I think most people do is buying an ETF called DOR, which trades in Canadian dollars, and then you journal to DOR.U, which is the US equivalent, and then you sell it, right? And journaling typically takes, I think, 2 days typically. And during that 2 days, if you're converting Canadian dollar to US dollar because an ETF or a stock is down like 10-15%, you kind of want to take advantage of that. But by waiting 2 days, you may miss out on that opportunity. So that's where it could affect you a little bit. Now, some people question, why do you want to trade between DOR/DOR.U? Why don't you trade, Royal Bank, for example? Royal Bank trades in both the TXX and also the US stock market. Why not journal between RY.TO and then RY on the US exchange? And the reason is because, Royal Bank the share price moves around. So you could either gain quite a bit because the share price increases, or you could lose a bit of money if it decreases, right? So there's that. Now, the other thing to consider, and I mentioned the brokerages usually charge anywhere from 2.5% exchange fee. Now, if you really think about it, unless you exchange a huge amount of money, that 2% isn't really that big a deal, in my opinion, right? Like if you exchange $500, that's only a $10 conversion fees. Like I would say for Norbert's Gambit to be really cost effective and really worthwhile to doing, you probably want to be converting somewhere in the 50,000 or more dollar amount, because 50,000 at 2%, that's $1,000. That's quite a bit of money, right? If you're only converting $1,000, that's only $20. Like, is it really worth that time and effort, right? So that's where some people, like, we move some of our accounts from TD and Questrade to Wealthsimple earlier this year, and a lot of my readers were saying, "Oh, Wealthsimple doesn't allow for Norbert's Gambit." Now they're coming out with that shortly, but for a while, Wealthsimple doesn't support Norbert's Gambit. And my argument to these readers has always been, well, like, is it really that big of a deal at 2%? Right? Are you actually, saving that much money effectively? So that's one thing. Now, while we talk about Norbert's Gambit, yeah, exchanging Canadian dollar to US dollars and try to find ways to convert it cheaper and avoid fees is great. But there's also another way to buy US listed stocks, right? So there's this thing called CDR, Canadian Depository Receipts. That's something started a number of years ago. Essentially, it's U.S. companies that are traded on the U.S. stock market, but then we have the Canadian equivalent, right? So you could trade Amazon CDRs or Google CDRs on the Canadian market and buy and sell these CDR stocks in Canadian dollars rather than US dollars. So that allows you to not have to worry about the exchange rate. And what happens is the CDRs basically has this complicated formula that accounts for the exchange rate, daily exchange rate. So Nelson, any thoughts on converting Canadian dollar to US dollars or CDRs?
So CDRs are a great product in theory until a bank got a hold of them. So I'm a bit of a cynical, kind of see the gray cloud and every silver lining kind of guy. And so I look at these from a very critical perspective. And I start out with, okay, why would, and BMO and CIBC who have come out with these CDRs, and it's mostly CIBC. They've a bunch of the US ones, and there's something like 40 or 50 different US stocks you can buy with this. Like, there's a fairly liquid market. There's quite a bit of choice. And so I look at it and it's like, okay, well, why would CIBC bother? Like, what's the point of this? The companies haven't gone to CIBC and said, hey, we desperately need exposure to the Canadian market, because Canadians can very easily just convert and buy on the New York Stock Exchange or the NASDAQ. Like, those are functions that have existed for a very long time, as long as there's been online trading. So, okay, so why do these exist? And the answer is, well, because Bob, you mentioned that complicated formula in terms of the exchange rate and the conversion. Well, the banks charge a management fee in doing that. And for most CDRs, it's something like 0.6%. Now, that is not the end of the world in terms of a very high MER or management fee. We all remember the days when mutual funds paid 2% or even 3% or higher MERs there. So from that perspective, it's not that bad. But at the end of the day, you as the client are still paying that. And if you have a long-term position in, say, Amazon or Costco or Walmart or whichever one of these CDRs, is that it's not going to be very many years until you pay more in management fees for these CDRs than you would have paid to convert the money to US in the brokerage anyway. You hold it for 3 years and it works out to about the same as just paying to convert it. So you have to think about that as well. But saying that, you do get a investment in a Amazon or whatever without taking on that currency risk. So the price of Amazon is always going to be reflected fairly accurately in Canadian dollars. So that's kind of my negative, sort of cynical, glass half empty view on CDRs. I think I would just rather pay the money once and just deal with that money being in the US. But saying that, you have to bring that money back at some point, don't you?
That's 100% true. But I think in agreement with you when it comes to CDR, I would rather own the real thing versus the Canadian equivalent that's made up by some Canadian banks, right? So take the hit initially, convert the money from Canadian dollar to US dollar, and then buy the real thing, right? So we own number of US stocks in US dollars. Now, obviously, you do have to convert it back eventually when you do sell, but that's you kind of have to. You can't really worry too much about it. That's later on in the future. One thing I wanted to talk about is, Nelson, you talk about the dividend side, the tax efficiency side of things, right? Like, obviously, owning Canadian dividend stocks is more tax efficient than owning U.S. dividend stocks, right? Because when you own U.S. dividend stocks, you have to pay this thing called withholding tax on dividends, and it's 15%. So if you hold U.S. dividend stocks in a non-registered account or a TFSA, and you receive $100 in dividends, you only get $85 effectively, right? So 15% of that goes to withholding tax. The way to avoid that is to hold these U.S. dividend stocks in RSP. That way you don't have to pay that 15% withholding tax. So that's one way to kind of increase your exposure to U.S. stocks or international stocks without paying that extra 15% withholding tax. So that's something to definitely consider when you want to look into international markets.
Yeah, that's a great point. And it's certainly worth mentioning that not only for US stocks, which like you said, you keep that in your RSP and the tax treaty is recognized, so you won't pay any withholding tax in your RSP. But in terms of other market dividends as well, 15% is a fairly kind of standard withholding tax across the board. Some countries are different, but for the most part, if you hold stocks in a foreign developed world country, you're paying that 15% withholding tax. And there are ways that you could get it back from the Canadian government if your tax rate is lower. I'm not an accountant. I'm not going to get into it. I'm just saying that this possibility does exist, but most likely is you won't qualify for it, or you won't have dividends big enough to qualify. So the point is that this exists, but in terms of as a strategy, I know that I've talked to people who have said that I don't want to invest in US dividend stocks because of this withholding tax. And I would really caution anybody listening to not let the tax tail wag the dog. And what I mean by that is that you don't want to just base your decisions on taxes. You want to look at other things besides taxes.
Yeah, for sure. And I've written a post about the dividend tax drag foreign withholding taxes on my blog. And there's been a lot of, we talk about individual dividend stock, but what about ETFs, right? ETF distributions. So I just want to touch bases on that. So how ETF distributions are taxed really depends entirely on how the ETF is structured. So there are three different structures, right? So one would be US listed ETFs that hold foreign stocks, Canadian listed ETFs that hold US listed ETF that hold foreign stocks, and then finally Canadian listed ETFs that hold foreign stocks directly. So it really depends on what they own inside the ETF and that whether that gets taxed or not. But typically if you hold an ETF, the distribution that they pay out is already net 15% withholding tax. So you don't really have to worry about that.
The other thing I will mention, a little bit off topic, you talked about it earlier in terms of brokerages and currency conversions and how you have to pay the 2%, et cetera. Keep in mind that if you have dividends in a US stock and it gets paid as a Canadian, your brokerage will very likely automatically convert that into local currency for you. And they do that because they want to collect that fee for converting. So just keep that in mind if you're at a traditional brokerage and they will default everything into Canadian dollars. It's another kind of little hidden fee that you'll pay on any US or foreign dividends.
Yeah, for sure. And you could set up your brokerage account, like some brokerages allow you to get paid in the whatever currency the dividend comes in. So that's typically under settings, or you have to phone them or contact them about these preferences, right? So that's something to keep in mind. And then another thing to keep in mind, since we're talking about taxes, is if you're holding U.S. dividend stocks inside a non-registered account, the dividends that you get is considered as working income. So that's taxed 100% at your marginal tax rate. So you don't get any of these preferential dividend treatment that a Canadian dividend stock would get, right? So that's why it may be beneficial to hold a U.S. dividend stock inside of your RSP rather than non-registered, on top of the whole 15% withholding tax consideration.
Yeah, it's these factors are what cause a lot of people to just kind of say, hey, I don't want US dividends at all, or if I do, I'm going to put them in my RSP. And before you make that decision for your own portfolio, of course, you got to do what's right for you. Don't listen to me. I'm just a guy in your ears right now. But I'll say that there are advantages to having a nice US dividend portfolio in terms of if you travel, you can take that and sort of use those US dollars to pay for any US dollar purchases that you might make when you're traveling, or you might make if you are purchasing whatever from the US. So my newsletter software, they charge me in US dollars. There's no avoiding it. They're a US company, but I can take some of my US dividends and use those to pay for that. So that's an advantage there, where you might not have to convert at all, because you can just sort of be patient and pay for US dollar things in using your US dollars. Hotel rooms, airline tickets, those are two other things you can very easily get the website to charge you in US dollars, and they're not looking to make any money on the conversion for a lot of these websites, so you can do that as well.
For sure. And we talked about dividend stocks, but non-dividend paying U.S. stocks, essentially you won't get hit by that 15% withholding tax. And when you do sell, you have to pay the capital gain. Now, one thing to keep in mind, it really depends on the brokerage that you're using. Some online brokers, if you're buying, say you have I'm talking about I guess could be any account, but I just keep it simple, a non-registered account. Some broker, if you buy in Canadian dollars and you say you want to buy NVIDIA and you're buying with your Canadian dollar account, then the broker buys the NVIDIA shares by converting your Canadian dollars and take the 2 to 2.5% fee on top of the exchange rate. So then now you own, say you bought 10 shares of NVIDIA, right? So now that's held in US dollars. But when you sell, they then convert it back to Canadian dollars and deposit that proceed in Canadian dollars. But then when they convert it back, they charge you that 2 to 2.5% fee again. So you're paying, with that transaction, you're paying anywhere from 4 to 5% fees, right? So if you if you make any capital gain, you're paying additional fees on top of that. So that's something to consider. Now, some brokerage, you could then tell them, when they sell, they hold the money in US dollars instead of converting it back to Canadian dollars. So just keep that in mind when you start investing outside of Canada and you're investing into the US dollar stocks.
Yeah, that's a really good point. Definitely worth mentioning. I'll say that for me, what I do is that when I've put money into the US and when I, convert my money, as far as I'm concerned, it's US dollars forever. I've, put that into whether it's my RSP, a lot of my US dividend stocks are my RSP for obvious reasons. That money is it's US dollars. And I think of it as US dollars for the rest of maybe not the rest of my life, because at some point I may convert that back, but for a very long time, like it's a long-term thing. And that's how you avoid these fees, is that you think about these things over the long term. You don't just convert currencies back and forth. And like you said, Bob, the brokerages make that easy. And like I said before, I think that there's a nice advantage to having a US dollar dividend stream that you can tap into kind of whenever you like US dollars.
Mm-hmm. So Nelson, we're about toward the end of the episode here. So just going back to this whole country bias idea, like if you were to start today, would you go 100% TSX list portfolio, or is that simply a bad idea?
I would not, but the reason I wouldn't really doesn't have anything to do with home country bias. What I've how I build my portfolio these days, if I had it to do kind of over again, is I would look for the best opportunities out there, whether they were in, whatever sector, whatever stock, and I would build my portfolio from that perspective. I would put the money in the best opportunities that I could find it, no matter what part of the world they were in. And yes, that does cut me off of a few countries, because ultimately the easy way to do that is to just use US listed ADRs and, like kind of companies from around the world. But in terms of geographic concentration, I really wouldn't care. I'm kind of agnostic about that. I would look where the best advantages or the best companies are. And, they're probably in the US these days. I love Canadian banks. I love our, utility companies. We have great life insurance companies. There are lots of great stocks in Canada, but it was a mistake for me to put so much of my portfolio in Canada. But again, not because of the geographical thing. It's because I just ignored good companies when they were cheap, and that was a poor move on my part. So Bob, how about you? Would you do how would you build your portfolio different now that you know a little bit more about this?
Yeah, I think on the same side as you, I would not focus on 100% TSX listed portfolio. Like I would look at where the opportunities are and which stocks make sense on the long run. I would not pigeonhole myself into a specific sector or specific country. I think generally speaking, when it comes to portfolio building, whenever you're setting all these funky rules, you're kind of restricting yourself, and that's a bad way to construct an investment portfolio, right? So you want to be open to ideas. You want to have the freedom to move around and invest in different sectors, different countries, and so on. So I would not restrict myself saying, oh, I know some people say, oh, I have to have, say, 50% in Canada, 50% outside Canada. I would not go as far as there. I would not put a number for my portfolio. I would just say, yeah, I would build a portfolio. I'm looking for value, and I would invest in whichever companies that I think make sense in long term. And with the popularity of ETF and with so many different investment ETFs available, it makes it a lot easier to construct your portfolio and move around, right? So there's so many different possibilities out there nowadays, I mean, heck, you could even just go 100% executive and forget about everything. That the fund companies build the percentage themselves, and then you pay a little bit of management fee. If you want to do that, that's perfectly fine. But if you want to do more DIY route and select some individual stocks, and maybe on top of that adding a few ETFs, that's perfectly fine too. So I think it doesn't make sense to restrict yourself to a certain rules or certain allocation. I would kind of look at investment from like 30,000 feet, like macro view, and really look at the trends and see what makes sense to invest your money in over the long term.
Exactly. And I think too that in terms of if you do have a very TSX concentrated portfolio, and I do, and I'm kind of like working towards getting that less and less sort of TSX concentrated, but saying that, like, it's not the worst thing in the world, and it's not nearly as concentrated in Canada as what you would think. So don't feel bad about that. You know, if that's what you want to do, and that tax advantage is a, you know, huge motivational factor for you, by all means, do it that way. So anyways, that's, I think, about it. I think we might have gone a little over this time. Sorry if you're, you know, on a deadline listening, but Bob, as always, it's been fun. And if you have any thoughts on home country bias, anything we talked about, we have comment sections on Spotify, on YouTube, kind of wherever you would get this podcast. Feel free to give us a comment. Let us know what you think. We're always interested in hearing from our listeners and our readers.
If you enjoyed the show, make sure you subscribe to never miss another episode. For more from Bob, visit his site at tawcan.com. That's TAWCAN, all one word. Nelson can be found at CanadianDividendInvesting.com. They're both on Twitter as well. Just search for Tawcan or CDI Newsletter. Thanks. See you next time.